All right, today is the 12th of August. I got the opportunity on Saturday to kind of, I wouldn't say celebrate, but in a way, remember 18 years ago is when I went through this major accident. August of 2008 was not a great month for a lot of people, and it was a real bad month for me. So, August 8th, 2008, I walked out of my home that morning, 190 pounds. I was had a credit score in the high 700s, net worth nearly $4 million. Things were in really, really good shape. Got wheeled back into my home several weeks later at 156 pounds with a negative net worth of about $1.5 million, with a credit score in the, eventually ended up in the 400s, and a memory that recycle every 3 to 4 minutes. So, I think about what I went through during that window of time. But what did my family have to endure, right? What did they go through? Because those assets that we had, I knew where they were. They didn't. My wife was a stay-at-home mom. She was taking care of kids, and now she had to take care of me. Think about that for a second while I go into today's discussion, right? It's going to be a little bit of a longer one, when we get into today's bond trade, because there's been a lot going on since we closed the market on Friday. And remember what I keep telling you: your mortgage is a bond trade. It's not what you think it is. And it isn't Kevin Warson, the Fed governor, sitting in a room picking the rate for your investment property. It isn't your loan officer, right? Me, shouldn't be anybody else. It isn't your realtor. It's every day billions of dollars are moving through treasuries, through treasuries, mortgage-backed securities based on what investors believe inflation, economic growth, oil and prices, government policy, and the value of the dollar is going to look like in the future. That's what's driving this. And the last 3 trading days, it gave us some pretty decent examples. Let's go back to Friday. Friday morning, we got the jobs report. Wall Street expected the economy to create about 80,000 jobs. Instead, payrolls fell by $23,000. That's a massive, massive miss. Normally, you see something like that and you expect the bond market just tear and just do amazing things. Bonds did a little rally, but not by much. The 10-year Treasury yield dropped about 3 basis points, and mortgage-backed securities picked up roughly about 1/4%, but it didn't last long. But that wasn't nearly the rally you'd historically expect from a jobs report like that anyway, right? So you expect it to rocket, you expect it to gain some ground, keep their ground, but it didn't keep their ground. Why? Because unemployment actually fell, and because the bond market is wrestling with something much bigger than an employment report: inflation. Friday ended with mortgage rates around the lowest levels we'd seen roughly in 3 weeks. We opened Monday and Wall Street basically said, nah, not real fast, guys. We're going to have oil moving higher again. Optimism around Iran and the Strait of Hormuz and other energy starting to get the challenges getting a little bit harder. On top of that, we had heavy corporate bond issuance competing for investment dollars, treasuries selling off, mortgage-backed securities giving back Friday's gains, and mortgage rates moving back into higher territory. That's important because I want you to understand the relationship. When oil rises significantly, the bond market doesn't only see a barrel of crude, it sees transportation costs. It sees shipping costs, agriculture costs, manufacturing costs, plastics, chemicals, construction, food distribution, basically everything that requires energy somewhere in the supply chain. And the bond market started asking one question: what's this going to do to inflation 6 months from today? Inflation destroys the purchasing power or the fixed payments because of what's happening in the US dollar. So bond investors demand a higher return because of what they think is going to happen. Bond prices will fall, yields will rise, mortgage interest rates will follow. Then we get yesterday. It was actually a pretty interesting day. Oil was still elevated. We were also sitting in the first half of a treasury auction cycle, which isn't necessarily the easiest environment for bonds. Yet the market held together. MBS finished stronger than when it started, but it still wasn't a positive day for it. We improved roughly a couple of basis points in the treasuries, and that was the bond market essentially saying we're waiting to see what's going to happen tomorrow, which is today. The July CPI report. We got it. Headline inflation came in at 1% for the month, year over year, 3.4%. Core CPI, 0.2% for the month and 2.5% for the year over year. Pretty much what Wall Street expected. Not another massive inflation surprise, not a disaster, and importantly, not enough evidence to dramatically increase pressure on the Fed to raise the rates in September. Now, we saw short-term treasury yields soften after the number. While the 10-year has been hovering roughly around 4.6, that tells you something. The report was friendly, but it was not a giant green light. We're in a little bit of a positive position on mortgage-backed securities, but we're also hitting, and I'll show you, we're going to see a little bit of resistance in a moving average. So we'll show that here in a little bit. Long-term inflation expectations are still going to matter, and they're going to matter a lot. Government borrowing still matters. The bond market isn't suddenly convinced that inflation has disappeared. Now let's bring this back to real estate. This is where it all matters because this is where people continually screw themselves. And unfortunately, you may be doing that yourself. They spend their entire life waiting for somebody else to create an environment that they want. They're waiting for the Fed. They're waiting for rates. They're waiting for Washington. They're waiting for the election, waiting for housing prices to fall, waiting for the boss to give them a raise, waiting for somebody to tell them it's now safe. I believe that's backwards. That's a principle I've been spending a lot of time of studying lately. Stewardship. Your family was entrusted to you, not to the Fed, not to the government, not to the banks, not to the rates, to you. You have a fiduciary responsibility. Your abilities were entrusted to you. Your time was entrusted to you. Your opportunities were entrusted to you. If you believe it, as I do, those things ultimately come from God. And someday you've got to account for what the hell you did with them. It doesn't mean to blindly buy real estate. It doesn't mean leveraging yourself until you can't sleep at night. It means accepting personal responsibility for learning how the system works and making it thoughtful decisions inside that system. You've been called. Now it's time to make a choice. There's an enormous difference between using debt and being owned by debt. Used responsibly, a 30-year fixed mortgage can be the most powerful instrument and the most powerful tool to the American family. But you guys are looking for an angle all the time. Well, let's talk a little bit about things a little bit differently. You can control an asset today. You can lock somebody else's capital in for a fixed period, for the entire fixed time that you own it. Meanwhile, rents can change, property values can change, income can change. Purchasing power of the dollar can change, but that principle of interest payment that was contracted stays the same. But is it really the same? It declines because of what you're paying it back with. That's not something to worship. It's a tool. And tools require a responsible operator. That's where red economics comes in. We're not trying to predict every wiggle in the bond chart. We're trying to understand the system well enough that the system doesn't control us. So let's look at that bond chart for a moment here. I'm going to pull that up. And here we are. As you can see, we're still in that downward movement. I'm going to expand this out a little bit so you guys can see this. We're still in this downward channel, in this downward movement. We're still, look at our tops are still going down. We're not convincingly getting into a better spot here quite yet. So that being the situation, guys, I want you to be certain here that you are making choices for you and it works for the deal, because I don't think we're seeing these really, really low rates that's coming that other lenders are trying to promise you. I don't think that's coming anytime soon. And since that time is not coming soon, in my opinion, and financial independence is just about having more money. It's about creating strength inside your household that your family can make decisions according to the conscience instead of desperation. Use all this information I'm giving you. That's what matters. A financially desperate family is easily controlled. They're controlled by their employer. They're controlled by creditors. They're controlled by government benefits. They're controlled by whatever institution happens to be writing the check. But families that saves, own productive assets, like what we're talking about, maintains liquidity, understands debt, structures its business properly and plans for the next generation, and lives beneath its means, it has choices. And choices is a fundamental component of our liberty. The ability to worship according to your conscience, the ability to educate your children according to your convictions, the ability to tell somebody when they're asking the ability to tell somebody no, when they're asking you to do something that violates your principles, the ability to take care of your parents when they're old, the ability to help your children when they're building their lives, the ability to give, to serve, the ability to withstand a bad economy without begging someone else to save you. That's why I don't look at acquiring real estate assets as simply how much money can I make. I look at it as what kind of structure am I building for my family? If you're according, let me just say something really important here. If you're acquiring property, protecting those assets appropriate through LLCs, trusts where appropriate, carrying reserves, paying down debt through the amortization, not the big chunks that people tell you, maintain your whole life and your property insurance and building something that can survive you, you're doing more than buying houses, guys. You're building an infrastructure for family. And that brings us all the way back to today's market. Don't worship the rate, study it. Don't fear the market, understand it. Don't blindly take debt, steward it. And don't turn your personal responsibility over to Washington, Wall Street, the Federal Reserve, or me. You have the freedom to make your own decision. With freedom comes responsibility. Just so you know, guys, we're not trying to guess here. We're trying to identify levels within the market that I'm showing you. We're watching the economic catalyst, and then we're making decisions based upon the assets sitting in front of us. Because the question isn't, Aaron, when do you think mortgage rates are going to go down? I don't know. Neither does CNBC, neither does your realtor, neither does the Fed. The question is, does this investment work with the capital available to me today? Can I operate it responsibly? Can I withstand adversity? Does it contribute to the long-term strengths of my family and the coming generations? Does it move the family towards greater independence rather than greater dependence? If the answer is yes, then stop waiting for somebody else to give you permission to build your future. That is today's bond trade. This is red economics. Take responsibility, build productive assets, quit jerking off, and make the trade.